Section 5, Legal and Regulatory Considerations, Hedge Funds, Strategies and Techniques for Advanced Investing. 5.1 Regulatory Framework for Hedge Funds. Understanding regulatory requirements and exemptions is crucial for hedge funds to ensure compliance with applicable laws and regulations. Here's an overview of some key regulatory aspects and exemptions commonly encountered in the hedge fund industry. Regulatory authorities. Hedge funds are subject to regulatory oversight by various authorities depending on their jurisdiction. For example, in the United States, hedge funds may fall under the jurisdiction of the Securities and Exchange Commission, SEC, or the Commodity Futures Trading Commission, CFTC. Familiarize yourself with the regulatory agencies that govern hedge funds in your jurisdiction and understand their rules and requirements. Registration and exemptions. Hedge funds may need to register with regulatory authorities unless they qualify for specific exemptions. Common exemptions include the private advisor exemption under the Investment Advisors Act of 1940 in the United States, which exempts hedge fund managers from registration if they have fewer than a certain number of clients and do not hold themselves out to the public. Other exemptions may be available based on the size of the fund, the nature of investors, example, accredited investors, or the fund's activities. E.g., commodity pool exemptions for certain types of funds trading in commodity futures contracts. Accredited investor and qualified purchaser. Accredited investors and qualified purchasers are categories of individuals or entities that meet certain financial criteria and are allowed to invest in hedge funds without specific regulatory restrictions. Accredited investors typically have high net worth or income, as defined by regulatory authorities. Qualified purchasers, as defined by the Investment Company Act of 1940 in the United States, generally refer to institutional investors with significant investment assets, anti-money laundering, AML, and know your customer, KYC, requirements. Hedge funds are required to implement robust AML and KYC policies and procedures to prevent money laundering, terrorist financing, and other illicit activities. These policies involve verifying the identity of investors, conducting due diligence on investors and beneficial owners, and monitoring transactions for suspicious activities. Disclosure and reporting requirements. Hedge funds are typically required to provide certain disclosures to investors, including the fund's investment strategy, risks, fees, conflicts of interest, and other material information. Regulatory authorities may also require periodic reporting, such as submitting Form ADV in the United States, which provides information about the fund's activities, financials, and key personnel. Insider trading and market manipulation. Hedge funds are subject to strict regulations regarding insider trading, market manipulation, and other unethical or illegal practices. Managers and employees must adhere to regulations that prohibit the use of material non-public information for trading purposes and engage in fair and transparent market practices. International regulations. If a hedge fund operates globally or invests in multiple jurisdictions, it must comply with regulations in each relevant jurisdiction. Familiarize yourself with international regulatory frameworks, such as the European Union's Alternative Investment Fund Managers Directive, AIFMD. To ensure compliance when conducting cross-border operations, it's essential to consult legal counsel or regulatory experts with expertise in hedge fund regulations to understand the specific requirements and exemptions applicable to your fund and jurisdiction. Compliance with regulatory requirements is crucial to maintain the fund's reputation, investor trust, and avoid legal consequences. Compliance with securities laws and reporting obligations is essential for hedge funds to ensure they operate within the legal framework and meet regulatory requirements. Here are some key aspects of compliance and reporting for hedge funds. Securities laws. Hedge funds must comply with the securities laws and regulations of the jurisdictions in which they operate. Understand the specific securities laws applicable to your fund, including registration requirements, licensing, and ongoing compliance obligations. Registration and licensing. Hedge funds may need to register with regulatory authorities, such as the Securities and Exchange Commission, SEC, in the United States or the Financial Conduct Authority, FCA, in the United Kingdom. Determine whether your fund is required to register as an investment advisor or as a commodity pool operator, CPO. Depending on the nature of your activities and the regulatory requirements, offering documents and disclosures, hedge funds must provide offering documents, such as a private placement memorandum, PPM. To potential investors, the offering documents should contain key information about the fund's investment strategy, risk factors, fees, conflicts of interest, and other material disclosures. Ensure the offering documents are drafted in compliance with applicable securities laws and accurately reflect the fund's operations and risk factors, investor suitability and KYC. Hedge funds are typically required to ensure that investors meet certain suitability criteria and conduct thorough Know Your Customer (KYC) due diligence. Evaluate potential investors to ensure they meet the regulatory requirements, such as accredited investor status or qualified purchaser criteria. Implement robust investor onboarding procedures, including verifying the identity of investors and conducting background checks as required by securities laws. Ongoing reporting and filings. Hedge funds are subject to various reporting obligations, such as regular filings with regulatory authorities and disclosures to investors. Examples of regulatory filings include Form ADV in the United States, which provides information about the fund's activities, financials, and key personnel. Timely and accurate reporting is essential to meet regulatory requirements and maintain transparency with investors. Compliance policies and procedures. Develop and implement comprehensive compliance policies and procedures to ensure adherence to securities laws and regulations. Establish a compliance program that addresses key areas, such as insider trading prevention, anti-money laundering, AML, code of ethics, personal trading, and conflicts of interest. Conduct regular internal reviews and audits to assess the effectiveness of the compliance program and identify any areas that require improvement or remediation. Periodic and annual audits. Engage an independent auditor to conduct periodic and annual audits of the fund's financial statements and compliance with regulatory requirements. The audit provides assurance to investors and regulatory authorities regarding the accuracy and integrity of the fund's financial reporting and operations. Insider trading and market manipulation. Hedge funds must comply with regulations that prohibit insider trading, market manipulation, and other unethical or illegal practices. Establish and enforce policies and procedures to prevent the use of material non-public information for trading purposes and ensure fair and transparent market practices. Regulatory engagement. Maintain open communication and engagement with regulatory authorities to stay updated on changes in securities laws and regulations. Respond promptly and cooperatively to any regulatory inquiries, examinations, or requests for information. It is crucial for hedge funds to work with legal counsel and compliance professionals who have expertise in securities laws and regulations. These professionals can assist in ensuring proper compliance with reporting obligations, staying abreast of regulatory changes, and addressing any compliance-related issues effectively. Regulations have a significant impact on hedge fund strategies and operations, shaping the way hedge funds conduct their business and manage their investments. Here are some key ways in which regulations can influence hedge fund strategies and operations. Compliance requirements. Regulations impose compliance obligations on hedge funds, including registration, licensing, and reporting requirements. Compliance costs associated with meeting these requirements can impact the operational expenses of hedge funds. Hedge funds must allocate resources and establish internal controls to ensure compliance with regulatory obligations. Investment restrictions. Regulations may impose restrictions on certain investment activities, such as limitations on leverage, short selling, derivatives usage, or investments in certain asset classes. These restrictions can affect the investment strategies employed by hedge funds and limit their ability to pursue certain types of trades or investments. Investor eligibility. Regulations often define eligibility criteria for investors, such as accredited investor status or qualified purchaser criteria. These criteria impact the investor base of hedge funds and may restrict their ability to attract certain types of investors. Disclosure and transparency. Regulations require hedge funds to provide disclosures and maintain transparency with investors. Hedge funds must provide comprehensive information about their investment strategies, risk factors, fees, conflicts of interest, and other material disclosures. Increased disclosure and transparency requirements may impact the level of confidentiality that hedge funds can maintain regarding their proprietary investment strategies and positions. Risk management and compliance programs. Regulations emphasize the need for robust risk management and compliance programs within hedge funds. Hedge funds are required to establish policies and procedures to identify, monitor, and manage risks, including operational, market, liquidity, and compliance risks. The implementation of these programs can influence the day-to-day operations and decision-making processes of hedge funds. Capital requirements and leverage limits. Regulatory frameworks may impose capital requirements and limits on leverage for hedge funds. These requirements aim to enhance financial stability and mitigate systemic risks associated with excessive leverage. Hedge funds must manage their capital levels and leverage ratios within the prescribed regulatory limits. Anti-money laundering, AML, and Know Your Customer, KYC. Hedge funds are subject to AML and KYC regulations aimed at preventing money laundering, terrorist financing, and other illicit activities. These regulations require hedge funds to implement robust procedures to verify the identity of investors, conduct due diligence, and monitor transactions for suspicious activities. Market integrity and investor protection. Regulations are designed to promote market integrity and protect investor interests. Hedge funds must adhere to regulations that prohibit insider trading, market manipulation, and other unethical or illegal practices. Compliance with these regulations ensures fair and transparent market practices and maintains investor trust. It is important for hedge funds to stay updated on regulatory developments and adapt their strategies and operations to comply with evolving regulations. Legal and compliance professionals play a vital role in helping hedge funds understand and navigate the regulatory landscape, ensuring that their strategies and operations remain in compliance with applicable laws and regulations. 5.2 Investor protection and governance. Investor rights and protections are crucial elements of the regulatory framework governing hedge funds and other investment vehicles. These rights and protections aim to safeguard the interests of investors and promote transparency and fairness in the investment process. Here are some key aspects of investor rights and protections. Disclosure and transparency. Hedge funds are required to provide investors with comprehensive and accurate disclosures regarding the fund's investment strategy, risks, fees, conflicts of interest, and other material information. The disclosure documents, such as the Private Placement Memorandum, PPM, or Offering Memorandum, enable investors to make informed investment decisions. Transparency ensures that investors have a clear understanding of the fund's operations, risks, and performance. Anti-fraud and anti-misrepresentation. Regulatory frameworks prohibit hedge funds from engaging in fraudulent or deceptive practices. Hedge funds must provide accurate and truthful information to investors and refrain from making false statements or misrepresenting material facts. Investors have the right to be protected against fraudulent activities, including misappropriation of funds, insider trading, or market manipulation. Investor suitability. Hedge funds are required to assess the suitability of investors based on their financial capabilities, investment objectives, and risk tolerance. This ensures that investors are not exposed to investments that are unsuitable for their circumstances or risk appetite. Hedge funds should conduct proper due diligence to determine whether investors meet the regulatory criteria for investing in the fund, such as accredited investor status or qualified purchaser criteria. Investor reporting and communications. Hedge funds are typically required to provide regular reports to investors, including financial statements, performance updates, and any material changes in the fund's operations. Investors have the right to receive timely and accurate information about their investments and the fund's performance. Hedge funds should establish effective channels of communication to address investor inquiries, concerns, and complaints. Redemption and withdrawal rights. Investors generally have the right to redeem their investments or withdraw their funds from the hedge fund, subject to any applicable lockup periods or notice periods. Hedge funds should clearly define the terms and conditions of redemptions and withdrawals in their offering documents. Investors should be provided with transparent and fair redemption procedures and treated equally in the process. Custody of assets. Regulatory frameworks often require hedge funds to ensure proper custody of investor assets. Funds should engage qualified custodians to hold and safeguard investor assets, reducing the risk of misappropriation or unauthorized use of funds. Investors have the right to expect that their assets are held by reputable custodians and are protected from potential fraudulent activities. Complaint resolution and dispute resolution mechanisms. Hedge funds should have mechanisms in place to address investor complaints and resolve disputes in a fair and timely manner. Investors have the right to seek recourse or resolution for any grievances they may have regarding the fund's operations or their investments. These mechanisms may include internal complaint resolution procedures or external dispute resolution options, such as arbitration or mediation. it is important for investors to thoroughly review the fund's offering documents, conduct due diligence, and seek professional advice when considering investments in hedge funds. Investors should understand their rights, responsibilities, and the level of protection provided by regulatory frameworks in their jurisdiction. Additionally, regulatory authorities play a crucial role in monitoring compliance and taking action against any violations to protect investor interests. Fund administrators and custodians play important roles in the operations of hedge funds. Here's an overview of their responsibilities and the value they bring to the fund management process. Fund administrators, accounting and financial reporting. Fund administrators are responsible for maintaining accurate accounting records for the fund. They prepare financial statements, including balance sheets, income statements, and cash flow statements, in compliance with accounting standards and regulatory requirements. Fund administrators also handle the calculation of the fund's net asset value, NAV, and ensure its accuracy. Fund operations and compliance. Administrators support the day-to-day operational aspects of the fund, such as processing subscriptions and redemptions, reconciling cash and securities positions, and handling corporate actions. They assist with compliance-related functions, including monitoring investment restrictions, regulatory reporting, and adherence to fund policies and procedures. Investor services. Fund administrators interact with investors, handling subscription and redemption requests, providing account statements, and addressing investor inquiries. They maintain investor records, including Know Your Customer, KYC, information, and ensure compliance with anti-money laundering, AML, regulations. Performance measurement and reporting. Administrators calculate and report performance metrics, such as fund returns, benchmarks, and risk measures. They may provide performance attribution analysis to assess the contribution of various investment factors or strategies to overall performance. Performance reporting helps investors and fund managers evaluate the fund's performance and make informed investment decisions. Regulatory compliance and reporting. Fund administrators assist with regulatory compliance by ensuring timely and accurate reporting to regulatory authorities. They help the fund meet regulatory requirements such as filing regulatory forms, maintaining records, and monitoring compliance with applicable regulations. Custodians. Safekeeping of assets. Custodians are responsible for the safekeeping and custody of the fund's assets, including cash, securities, and other investments. They hold the assets in segregated accounts, maintaining their physical or electronic records. Custodians help protect the fund's assets from loss, theft, or unauthorized use. Settlement and reconciliation. Custodians facilitate the settlement of securities transactions, ensuring the timely and accurate transfer of securities and funds between counterparties. They reconcile the fund's transactions and holdings with those of the counterparties, verifying the accuracy of the records. Asset servicing. Custodians handle various administrative tasks related to the fund's assets, including income collection, corporate actions, and proxy voting. They ensure that income distributions, such as dividends or interest payments, are correctly allocated to the fund. Compliance monitoring. Custodians assist with compliance monitoring by ensuring that the fund's investments and activities comply with regulatory requirements, investment restrictions, and other legal obligations. They help monitor compliance with anti-money laundering, AML, regulations, insider trading rules, and other regulatory frameworks. Reporting and disclosure. Custodians provide regular reporting to the fund on the custody and movement of assets. They help prepare and distribute investor reports and statements, reflecting the holdings and transactions within the custody accounts. Fund administrators and custodians play critical roles in ensuring the accuracy, efficiency, and integrity of the fund's operations. By outsourcing these functions to specialized service providers, hedge fund managers can focus on investment management while relying on the expertise of administrators and custodians to handle administrative, accounting, and custody-related tasks. Corporate governance and fiduciary responsibilities are essential aspects of managing a hedge fund and ensuring the interests of investors are protected. Here's an overview of corporate governance and fiduciary responsibilities in the context of hedge funds. Corporate governance. Board of directors. Hedge funds may have a board of directors or a similar governing body responsible for overseeing the fund's operations and providing strategic guidance. The board ensures that the fund is managed in accordance with applicable laws, regulations, and fiduciary duties. Board members may include both internal and external directors with relevant expertise and experience. Fiduciary duties. Hedge fund managers have fiduciary duties towards their investors, which include acting in the best interests of the fund and its investors. Fiduciary duties encompass duties of care, loyalty, and utmost good faith. Fund managers are expected to make investment decisions prudently, avoid conflicts of interest, and act honestly and in good faith in managing the fund. Conflicts of interest. Hedge funds must actively identify, manage, and disclose any conflicts of interest that may arise between the interests of the fund manager, employees, or affiliates, and those of the investors. Fund managers should establish procedures to prevent conflicts of interest from compromising the fair treatment of investors or undermining the fund's integrity. Risk management. Effective corporate governance includes robust risk management practices. Hedge funds should have risk management policies and procedures in place to identify, assess, and mitigate risks associated with the fund's investment strategies, operations, and external factors. Risk management practices should align with the fund's investment objectives and risk appetite. Compliance and internal controls. Hedge funds are expected to maintain strong compliance frameworks and internal controls to ensure adherence to applicable laws, regulations, and internal policies. This includes establishing compliance programs, conducting regular compliance reviews, and implementing controls to prevent violations of regulations. Fiduciary responsibilities. Duty of care. Hedge fund managers have a duty of care to act with reasonable care, skill, and diligence in managing the fund's investments. This involves conducting thorough research and analysis, making informed investment decisions, and continuously monitoring and evaluating the fund's investments. Duty of loyalty. Hedge fund managers have a duty of loyalty to act in the best interests of the fund and its investors. This duty requires avoiding conflicts of interest, ensuring fair allocation of investment opportunities, and prioritizing the interests of investors above personal or third-party interests. Investment decision-making. Hedge fund managers have the responsibility to make investment decisions that align with the fund's investment objectives and the expectations of investors. This includes selecting suitable investment strategies, conducting thorough due diligence on investments, and managing portfolio risks effectively. Transparency and communication. Hedge fund managers have a responsibility to provide clear and timely communication to investors, including disclosures on the fund's performance, risks, and any material changes in the fund's operations. Open and transparent communication helps investors make informed decisions and maintain trust in the fund manager. Compliance with legal and regulatory obligations. Hedge fund managers have a fiduciary responsibility to comply with all applicable laws, regulations, and fiduciary duties. This includes meeting regulatory reporting requirements, ensuring proper valuation of assets, and maintaining accurate records, adhering to strong corporate governance practices and fulfilling fiduciary responsibilities are vital for hedge fund managers to build trust, maintain investor confidence, and mitigate potential conflicts of interest. It is crucial for managers to establish and follow robust internal policies and procedures that promote transparency, fairness, and the long-term interests of investors. Compliance with relevant regulations and fiduciary duties should be a fundamental part of the fund's operations and decision-making process. 5.3 Emerging trends in hedge funds. The hedge fund industry is dynamic and constantly evolving in response to market trends, regulatory changes, and investor demands. Here are some notable industry developments and evolving trends. Increased regulatory scrutiny. Regulatory authorities have been implementing stricter regulations and oversight on hedge funds to enhance transparency, mitigate systemic risks, and protect investors. Reporting requirements, registration obligations, and risk management standards have been reinforced to ensure compliance with regulatory frameworks. Alternative investment strategies. Hedge funds are increasingly exploring alternative investment strategies beyond traditional long/short equity and global macro approaches. Strategies such as quantitative investing, artificial intelligence/machine learning-based trading, and cryptocurrency investments have gained popularity. ESG integration, environmental, social, and governance (ESG) factors have become a prominent consideration in hedge fund investing. Many hedge funds are incorporating ESG criteria into their investment processes, aiming to align investments with sustainability goals and meet investor demand for socially responsible investments. Technology and data analytics. Hedge funds are leveraging advanced technologies, including big data analytics, machine learning, and artificial intelligence to enhance investment decision-making and risk management. Data-driven strategies and quantitative models are increasingly prevalent, allowing for more sophisticated analysis and faster execution. Fee structures and investor demands. Investor demands for lower fees and increased transparency have influenced the fee structures of hedge funds. There is a growing trend towards performance-based fees and alignment of interests between fund managers and investors. Funds that provide greater transparency in terms of holdings, investment strategies, and risk management have gained favor. Focus on risk management. Risk management practices have become a top priority for hedge funds. Funds are adopting more comprehensive risk management frameworks, stress testing, and scenario analysis to identify and mitigate potential risks. Robust risk monitoring tools and compliance systems are being implemented to ensure adherence to regulatory requirements. Rise of outsourced services. Hedge funds are increasingly outsourcing non-core functions, such as fund administration, compliance, and cybersecurity, to specialized service providers. Outsourcing allows fund managers to focus on investment management while benefiting from expertise, cost efficiencies, and scalability offered by external service providers. Collaboration and partnerships. Collaborations and partnerships between hedge funds and other industry participants, such as technology firms, data providers, and research institutions, have become more prevalent. Such partnerships enable access to specialized expertise, innovative technologies, and alternative data sources, enhancing investment capabilities. Investor education and engagement. There is a growing emphasis on investor education and engagement, aimed at improving transparency, communication, and understanding of hedge fund strategies and risks. Investors are seeking more customized investment solutions and personalized reporting, leading to increased dialogue and collaboration between fund managers and investors. Global expansion and emerging markets. Hedge funds are expanding their presence in emerging markets, driven by opportunities for high growth and diversification. Market liberalization, regulatory reforms, and increased investor interest in emerging markets have contributed to the expansion of hedge fund activities in these regions. It's important for hedge fund managers to stay abreast of industry developments, regulatory changes, and evolving investor preferences to remain competitive and adapt to the evolving landscape. Continuous innovation, adoption of technology, strong risk management practices, and adherence to industry best practices are key factors for success in the ever-changing hedge fund industry. The impact of technology in data analytics on the hedge fund industry has been significant and transformative. Here are some key ways in which technology and data analytics have influenced hedge funds. Enhanced investment decision-making. Technology and data analytics provide hedge fund managers with advanced tools and techniques for investment research, analysis, and decision-making. Data-driven insights enable managers to identify investment opportunities, assess risks, and optimize portfolio construction. Advanced algorithms and machine learning models help uncover patterns, trends, and relationships in large datasets, leading to more informed investment decisions, quantitative and systematic strategies. Hedge funds have increasingly embraced quantitative and systematic investment strategies driven by technology and data analytics. Quantitative models and algorithms are used to generate trading signals, execute trades, and manage portfolio risk. These strategies leverage historical data, statistical analysis, and computational power to exploit market inefficiencies and generate alpha. Alternative data sources. Technology has enabled the collection and analysis of alternative data sources that were previously inaccessible or underutilized by hedge funds. Satellite imagery, social media sentiment analysis, web scraping, and other sources of unstructured data provide valuable insights for investment analysis. Incorporating alternative data into investment processes allows for more comprehensive and timely analysis, giving hedge funds a competitive edge. Automated trading and execution. Technology has revolutionized trading and execution processes in hedge funds. Algorithmic trading systems enable high-speed, automated execution of trades based on predefined rules and strategies. Automated trading improves efficiency, reduces manual errors, and allows for faster reaction to market opportunities. Risk management and compliance. Technology and data analytics have strengthened risk management and compliance practices in hedge funds. Sophisticated risk models and analytics tools help assess and monitor portfolio risk in real time. Compliance systems automate regulatory reporting, monitor investment restrictions, and enhance adherence to compliance requirements. Operational efficiency. Technology has improved operational efficiency in hedge funds, streamlining back-office processes, reporting, and communication. Automated workflows, integrated systems, and cloud-based platforms facilitate seamless operations and collaboration. Increased efficiency allows fund managers to focus more on investment analysis and decision-making. Cybersecurity and data protection. The adoption of technology brings cybersecurity and data protection concerns to the forefront for hedge funds. Hedge funds need robust cybersecurity measures to protect sensitive investment data, investor information, and trading systems from cyber threats. Data encryption, secure communication channels, and strict access controls are crucial for safeguarding confidential information. Investor transparency and reporting. Technology enables hedge funds to provide more transparent and detailed reporting to investors. Interactive dashboards, online portals, and personalized reports allow investors to access performance metrics, portfolio holdings, and risk analytics, real-time. Reporting and transparency foster trust, improve investor relations, and meet the growing demand for greater transparency, while technology and data analytics bring numerous benefits to hedge funds. There are also challenges to address, such as data quality, privacy concerns, algorithmic biases, and the need for skilled data scientists and technology professionals. Hedge fund managers need to carefully integrate technology and data analytics into their investment processes, ensuring they align with the fund's objectives and comply with regulatory requirements. Striking the right balance between human expertise and technological advancements is crucial for leveraging the full potential of technology in the hedge fund industry. ESG, environmental, social, and governance considerations have gained significant prominence in hedge fund investing in recent years. Hedge funds are increasingly incorporating ESG factors into their investment processes to align with investor preferences, manage risks, and seize opportunities related to sustainability and responsible investing. Here's how ESG considerations are impacting hedge fund investing. Integration of ESG factors. Hedge funds are integrating ESG factors into their investment analysis and decision-making processes. ESG considerations involve evaluating companies' environmental impact, social practices, and governance structures. Hedge fund managers assess how ESG factors may impact a company's financial performance, risk profile, and long-term sustainability. Risk management and performance enhancement, ESG analysis helps hedge funds identify and manage potential risks associated with environmental and social issues. Evaluating a company's ESG practices can provide insights into reputational risks, regulatory compliance risks, and potential litigation risks. Effective risk management through ESG integration can lead to improved risk-adjusted returns and long-term performance. Value creation and competitive advantage. Hedge funds recognize the value creation potential of companies with strong ESG performance. Companies with robust ESG practices may have a competitive advantage, attracting customers, talent, and investment. By investing in companies with strong ESG profiles, hedge funds aim to benefit from their sustainable business models, innovation, and long-term growth prospects. Impact investing and sustainability goals. Some hedge funds engage in impact investing, focusing on investments that generate positive social and environmental impact alongside financial returns. Impact-focused hedge funds actively seek out investments in sectors or companies addressing specific sustainability challenges, such as clean energy, healthcare, or education. By aligning investments with sustainability goals, hedge funds contribute to positive social and environmental outcomes. Shareholder engagement and activism. Hedge funds may engage in shareholder activism, using their influence to promote ESG improvements within companies. Activist hedge funds may push for changes in corporate governance, disclosure practices, or environmental strategies to enhance value and address ESG concerns. Shareholder engagement can encourage companies to improve ESG performance and respond to investor demands. Reporting and transparency. Hedge funds are increasingly providing ESG-related reporting and disclosure to investors. ESG reporting may include details on the fund's ESG investment criteria, the integration process, and the ESG performance of portfolio companies. Enhanced transparency allows investors to assess a Hedge funds' ESG approach and make informed investment decisions aligned with their values, regulatory and investor expectations. Regulatory bodies and institutional investors are placing greater emphasis on ESG considerations. Encouraging hedge funds to incorporate ESG factors into their investment processes. Regulatory frameworks, such as the EU Sustainable Finance Disclosure Regulation, SFDR, impose reporting obligations on funds regarding their ESG integration and sustainability-related risks. Institutional investors increasingly consider ESG factors as part of their due diligence and investment selection process, influencing hedge funds to adopt ESG practices, while ESG considerations have become more prominent in hedge fund investing. Challenges remain, including the standardization of ESG metrics, data availability, and the need for comprehensive ESG analysis frameworks. Hedge fund managers need to develop robust ESG integration strategies and access reliable ESG data to effectively incorporate ESG factors into their investment decisions and meet the expectations of investors seeking responsible and sustainable investments.